have Tom Suvansri with us here today. And to follow along, everybody, I'm going to direct you to their webpage. Head over to perennialpride.com. And we're going to talk about quite a few things, but in the end, we're going to break into what Tom refers to as family banking. And this is going to be a bit different from, some of the banking structures that we've seen before. But in the nutshell, how would you describe that, Tom?
To me, it's so thank you first, Jake, for letting me on here. This is a big fan of what you do, and hopefully I can provide some value to your audience. Yeah, when I think about family banking, it's not a physical bank, of course, but it mimics the function of a bank in the sense that it provides a great storage facility for families, but it gives people an opportunity to finance things themselves in a lot of ways and recapture interest that the banking institutions would typically take from us if we want to use them. So a lot of this is centered around a lot of the old school ways of, even like the Rockefeller family is the best the family most people would know that would adopt this, that they used uniquely designed life insurance policies as to store their wealth and then control the financing for their businesses, real estate, whatever they want to invest in, that their family gets to benefit and use instead of having to go to the bank if they want to, if they need to. So it just gives you a more ownership and control, and provides a sort of storage bin for wealth for families.
Sure. So some people might be familiar with infinite banking, but this is kind of Tom's own spin on it. I really kind of am interested in diving into this a little bit further, because in the end, when it comes to real estate investing, part of it is about that generational wealth and protecting it for the next generation. But before we go there, I'm really curious, and we're going to delve a little bit to Tom's surprise, probably a little bit of mindset, because I think it's fascinating that you were in the pharmaceutical industry for 15 years and you made a pretty drastic shift in your career going into this. Like what caused that?
Yeah, it's fascinating. I think a lot of the, I try to follow the model of going to school, get a great job. This is what they tell you. And my parents came here as immigrants and gave us tremendous opportunities. So I followed that path and went to graduate school and thought I was doing well. And I kept at the job, and it kept me sort of locked in that world. And as I started realizing things, especially around my own financial life, that I didn't feel like I had a lot of control. And similar with my job, I didn't feel a lot of control. And as I started watching and learning more about different ways people are managing their wealth, it got me interested. Obviously, real estate was one area, and it sort of led me to continue to get educated. I'm just a perpetual learner. And I was learning from things like Rich Dad Poor Dad, which I'm sure a lot of people have come across, and learning about different ways of how people are building their wealth. And it wasn't what I was taught, or at least what everyone is marketed to. So I started just learning through that while I was working at Pfizer, and learn all these unique strategies like infinite banking, and learning about real estate while I was working, because I just wanted to understand it. It's my nature. I'm a science guy by trade, and I wanted to see the truth. And so it took me a little while to learn it and investigate it and see what was right. And it led me to try and experiment with a lot of these different financial strategies. And I started falling in love with it. And it allowed me to build wealth and income streams, so to allow me to leave my job and have the choices of what I get to do daily and who I get to do that with.
A lot of people will make this type of shift when they're experiencing some sort of pain in their current situation. Was that the situation here?
Well, some of it was pain in the sense that, just like everyone experienced 2008 and some of the pain from the crash there, and didn't like that feeling, but also pain in that I didn't feel fulfilled in a job anymore. And I was looking for more out of life. So I think that was a kind of a sort of impetus to me to explore. And I'd gone through this a lot too. I've seen as I grew older, I recognized that my parents who came over here, father was a physician, on the surface, very successful practice that him and my mother managed. But I slowly found out that they were really having financial struggles, taking risky bets and not managing their wealth. And it really was saddening to watch it all happen as I was an adult. And it pushed me to even take more emphasis and say, I need to control my wealth or someone else is going to do it for me. And it likely wouldn't result in what I would want. So a lot of those pains, unfortunately, came not directly at me, but through my family. And it's compelled me to think about my family's wealth and generational wealth. More importantly, how do I start what I think what my parents started us on? They just found some missteps along the way. So it's really inspired me to pursue that for my family and the generations that follow.
So when you made this career shift, did you do it slowly, or was it like just jumped right in once you've got your mind made up?
I'm a slow starter in that sense. Because of my nature of having to research, and I like facts, and I want to test things out and make things sure that they're correct. It did take me a little while because I want to understand the truth. A lot of the things I was learning, they were counter to what I would typically hearing all over the place. And so took me a little while to get into it, meet more people and formulate my own sort of theories and opinions about it. So it did take me a while. I dipped my toes in, and the more I dipped, the farther I got, and I just met some tremendous people along the way that, are today good friends of mine and advisors that I still keep in touch with, or mentors of mine. And it's just been a blessing to be able to, meet them along the way. But it did take me a little while because it's just my nature of experimenting and testing things out.
So if somebody is listening to us here right now, and if they were thinking of a career shift, a big career shift like this, what would you recommend? What did you learn from this shift? And what would you have done differently?
The biggest thing I learned out of that shift is, as I sort of ventured into, and I'll give you, this is the story that epitomizes it all. I went to a real estate meetup. You have these all over the place and people go in and meet. And I was a little hesitant. I was a little scared. I don't know anything about real estate. I walk in, I figured I'll try. I almost did not walk in, right? I almost stepped back in my car and walked and drove home. I went in, went through the meeting, didn't get a lot out of it for most of it. As I walked out, I caught eyes with a gentleman and we started talking and we hit it off really well, really intriguing. We met for the next year, and this guy, we've done so many deals together over the years. And it was just one of those things that I said, listen, you've got to get yourself out there, have the courage to meet and ask questions and talk to more people and learn, and don't be fearful of it. I learned that more often than not, people are willing to talk to you and even help you if you're willing to be open yourself. And I think it just took a little more courage, and through that, now it doesn't faze me, right? It's, everyone's got something that they don't know. And as long as you're open and honest and sort of look to try to help them out as well and learn about them, I think it's always can lead to, at minimum, a good friendship, but even better, a potential fruitful business partnership or venture together. So just don't be nervous about it.
So during this whole process, then you talked about Rich Dad, Poor Dad, and you get into some real estate investing. What was your first foray into that? Like, what did you jump into regarding
the first, and it was actually off of that meeting I had in a real estate meetup. I had not done any real estate up to that point. And so in that conversation with a gentleman who was a very active real estate investor in the area, I just asked him, what is it that you most need now? And what he needed was capital. So that's what I had plenty of. I had no experience. So that's why I helped him. And we partnered together for a whole bunch of deals and helped him build his wealth. And then in reverse, he helped me sort of secure my first real estate property right in the area. And it was a tremendous, they still own it today. It is a massively beneficial asset I own. And it was because of that first encounter that all spurred there. So it started me down the road of experience and learning about all different facets of real estate and what I liked and didn't like about the different areas. Because as you have all your guests on different ways to do real estate investing. I kind of started there though by just lending my own money, and I did that through my life insurance.
Sure.
Yeah, so that's where I lent money from my life insurance policy. I borrowed their money to loan to him, and I took a 4 or 5% or loan and made it into 15. So just by siphoning, my money was still working in the background. So that's what I learned, that through that sort of infinite banking, family banking sort of environment, how you can control that and keep more of your dollars moving at all times.
Well, I think let's jump into the life insurance and what you refer to as family banking here. Let's face fact, like whole life insurance has kind of gotten a bad rap over the last number of years. I don't know if we can point the finger at certain popular financial radio hosts,
Yeah.
but that's where I'm probably going to point it. But let's break some myths regarding this. Like, what can and can't, what's some of the benefits of whole life insurance, and what are some of the downfalls?
Yeah, and I'll start with just a general myth, right? I mean, when we think about, and I separate these things in my head very clearly when I'm dealing with my clients, what's an actual investment? And usually what people are saying about whole life insurance, oh, it's the worst investment you can make. And I said, well, I would agree with you, because it's not even an investment. It helps to, it's a storage bin of wealth that is guaranteed to only go one direction and never lose. So to me, investments entail including some risk and risk of loss, right? So to me, it's equivalent to a savings vehicle, something you can draw from. And that's why it's sort of akin to a family banking environment if you understand how it functions, right? So to me, that is usually the biggest thing I need to help people understand. It can be a very powerful asset if you understand what it is, but they're making apples to orange type comparisons across the board. And it sort of makes it very confusing for people. So for me, I use it as a vehicle to pass, just like everyone's dollars go through, where's the first thing, their paycheck or wherever the money goes into a bank. Well, you just take a slight little detour into a different asset, is called whole life insurance. And so the reason I love it, and most people want to protect their families, right? And we, in this day and age, we know, as far as I'm aware, we're all mortal, right? That is a certainty. It's going to happen. So I said, and I also believe our number one asset on this earth is us. So why not protect it to the max? And so I use that sort of philosophy to say, okay, let's protect ourselves in this, store cash, right? Because it's a great place. We need to store cash somewhere before we deploy it. But why not use and it's tax sheltered, which is also a very huge benefit, right? That's why a lot of very wealthy people use this, is a tax sheltered environment, and can be tax free. And then there's a contractual guarantee to allow you to borrow money, just like a home equity line of credit, right? That you can borrow against an asset while not actually consuming that asset. And exactly works the same way. It's just, instead of the house is you use a home equity line against, right? You're in a life insurance policy. The death benefit is the entire asset value. And someday you will pass, and that will go to your family, charities. But while you're living, you get to consume and use those assets to build your wealth, to fund education, to give to charities, whatever you want. But no one gets to tell you when you get to use it. You have freedom and control of it. And that's the beauty of, to me, the family banking environment is, to be able to use that to supply everything you want for your family, and your businesses. But then when you do leave this earth someday, whenever that happens, that asset now transfers to your family. And that, to me, is the essence of family banking. And then they can use it to perpetuate their lives, their businesses, whatever they want to do, investment wise. They can use those same funds. And that's exactly what the Rockefeller family, obviously within a trust, had done this. And they put a life insurance policy on anyone who gets born in that family. And that's what I've done for mine. My children have policies from day one when they're the healthiest. And now they have a runway of hopefully 80, 90 years of building wealth that they're going to be able to use and leverage wherever they want.
Sure. So just to remind everybody, head over to perennialpride.com to check out what Tom has a few guides and things there that you can download to kind of get a clearer picture of what we're talking about here. But in order to get a clearer picture, Tom, I was hoping you could kind of give us an example. Like, let's start from beginning to end. Like, when somebody comes, gets one of these policies to, and since we're a real estate investing podcast, let's talk about how somebody you've helped use this to acquire a property.
Yeah, so it's more recently I had a business owner who was looking to get into real estate, and he had a bunch of money sitting in the bank, and he has family protect, right? And so he's trying to figure out how to deploy this. So when we're designing things using a family bank, it's centered around building as much cash as available immediately. This is the thing that most people dislike about whole life insurance, because early in the typical way these are designed, there's very little cash available because it's holding a massive, potentially massive $1 million or plus death benefit. So a lot of your money is kind of being held for a little while, right? So the way we design them in this situation, we put in, so he had access to nearly 85% of his cash right up front to use and secure. He was securing nearly $5 million by putting like $100,000 into a policy. And he had access to 85,000 of it. He borrowed against it to actually fund a real estate deal, right? He was going to just give the bank away, but now what has happened here, although he doesn't have access to all his money, he has an asset he's starting to build and grow and own in a death benefit of $5 million, right? That he's now secured with very little money. And now he has access to guaranteed financing and use that as a down payment for the real estate deal, right? And that's what he can use that for. The cash flow that's generated from that will come back to pay off the loan in the life insurance policy and start paying down the loan in the policy from the policy. And then every time he does that, more money becomes available, right? It's an automatic sort of line of credit that you have control over. And the beauty of it is that if anything happened, look what happened with COVID and people stopped paying rent. Well, because of the nature of the line of credit tied to these policies, there's no terms other than the interest rate. So you can stop and pause. Nobody tells you when to pay it because they're using your death benefit as to pay it off just in case, right? You're going to eventually pass. So that cleans out any loans down the road. So it's a very safe loan for life insurance. So you have control of that note. And if you need to, you can pause. So this is where it can be hugely beneficial. Now, it takes some time. The downsides of it is that some of your money is tied up early because it is putting the life insurance company at significant risk, right? Because you may pass. So that has to build up over time. But if we design it in a way, you can have a lot of money up front. And then within the first, probably the third or fourth year, every dollar you're putting into this will show up as additional cash for you to use. And it just gets bigger and bigger every year. It gets better as you even get older. And so that's the downside of it. It does take a little time to capitalize, but just like any good business, which we know, not all businesses start with profit. Businesses take time to mature. You're actually building a banking business for yourself. In reality, you're capitalizing with your own funds and you get to use the life insurance company. And even banks will loan against this today because they know the security of that cash. It's not going away. So they also will lend you money against it as well if you want to do it that way.
Okay, so just to clarify something then, the value there that you can lend are you lending yourself the money to a certain extent?
Well, you're basically using the life insurance company's sort of general money and borrowing from them. So you are borrowing from the life insurance company, but all your dollars that you have as cash haven't been touched. They're just being used as collateral. And
Okay.
they continue to grow and compound over time.
So let's say you're like in this case, the example you just gave, he's got a $5 million policy. You're not getting a percentage of the 5 million. You're getting a percentage of what you have in essentially that savings account.
Yeah, like if you treat it like a home equity, like an equity, whatever
Sure.
equity is in the house, in this case, it's the asset of life insurance. You can borrow against that as use it as collateral, that cash. but the cash continues to grow. If we did it in the regular bank way, you have to literally withdraw that money
Sure.
and stop
So,
collecting.
where I was getting at is that when you are paying this loan back, so your money is staying in that account no matter what.
Yes.
And now you have this essentially this other bucket of money that the insurance company is lending you. When you are paying it back with interest, does that interest go back into your account and continue to help grow your portfolio, or is that interest just paid to the insurance company? And
Yeah.
am I making sense?
Yes. Yeah. It's the latter. So most of it, it's going to pay the note from the life insurance company. So it is an actual loan, right? It
Sure.
is physically a loan separate from your cash. So the beauty is your cash, though, goes untouched and allows to grow uninterrupted for decades, right? And compound on self tax-free in there. So you're using that bolus of money just as a piece of collateral. If you pay extra in it, yes, it would start building up your cash even more. Just like if you're paying your house down faster, it's going to go to principal,
Sure.
right? So it acts in the same way. I think of them very similar in nature of assets. It's just you have a little more flexibility in a life insurance policy because you can skip payments if you want to, right? And you pay more when you want to, and they don't say no, I can't take it away from you, right?
Right.
Like a home equity line. So you can use them in the same fashion. It's just you have more control over it.
So with that all being said, you mentioned it could take some time. Like what typically what is the tipping point where you're putting money in? At what value is it worthwhile to consider taking out that loan?
Yeah, because I think, depending on the nature, if you're aggressive, you could put a large amount in and you could take it out like in that same year and use it. So the typical way that we sort of design them, within the first 5 years, literally every dollar you put into this policy will be as cash, right? You've kind of broken even. So that's where you just recognize some of the money is held up in comparison to a bank, but this is where we think long term. Long term with this will massively outpace any bank account you could ever imagine, right? In a tax-free zone. But the early stages, you just recognize that you're building and you're behind a little bit. I kind of equate it to like a marathon. If you're running a 26.2 length marathon and you're behind the first mile or two, but you're eons farther away at the end, do you really care, right? Most people don't. And you just have to recognize that's the sort of structure of these policies. And, you're going to pick up on this and surpass it very soon within 5 years.
Sure. So, and I hate to put you on the spot like this, but are we talking about 20,000 in the account, 50,000 in the account? Like what value is it going to be worth it?
Yeah. And that's where it's going to depend, because obviously you have to qualify. That's the challenge with it, is some people are not healthy enough to get it. So it will depend on your income, your asset values, because they have to evaluate, what you even qualify for. To me, I said, if you're going to do this, at minimum, if you're depending on what you're planning on using it for, most people in the 5 to 10,000 a year range. But frankly, the idea is that even if you did that, most of your money's already you're going to be able to access it. So it's not like all that money just goes away. Right. So to me, it does vary. I mean, I had people putting in 5 to 10,000, and I had people putting in well into the six figures, right? Because they see where it gets used, right? So afterwards, once they understand the philosophy of it and recognize that it's also protecting their family for 50 to 100 times their premium, they see that it provides much more utility than a simple bank, right? So they can use it in different facets and help manage actually their protection of their families, but also their tax liabilities, because everything in there can be free from taxation for their duration of their lives and for the next generation.
So you've mentioned the tax benefits a couple times here now. Can you explain a little bit how it is a tax benefit and how it's protected?
So in by the way these are designed, that when you are contributing, obviously you're contributing after tax. So we think about a Roth IRA equivalent. the money going in after tax. But as it's building in there's guarantees with that cash, but you're getting dividends along with it because we're using companies that you're kind of like a part owner. Just like if you were a shareholder of a stock-based company, we use companies where the insured people are actually owners of the company. So you're eligible for dividends, and that goes to your cash as well and builds that up along the way. And you don't get taxed on any of that along the way. And so it builds the cash value, builds tax-free, and then obviously the death benefit, if you did pass, would go tax-free to your beneficiaries. When you're pulling out money for loans, that's a tax-free sort of use of dollars in a lot of ways. That's why people like to do that. You hear like Elon Musk, he doesn't sell his stock because it would result in a gain. So here we're leveraging dollars. Even if there's a gain, we can take a loan and then the asset still continues to grow. So we're essentially taking tax-free dollars from our gains. And so because of the way we use this, we can create loans even towards the end of our lives. And then when we die, all the tax-free money from the death benefit will pay off the loan. The rest goes to your family tax-free. So you can store cash tax-free, you can borrow against it and use it through life tax-free, and even withdraw it. And then when it passes to the next generation, there's no taxes. And for people who have significant estate tax challenges, depending on where the laws go with it, that there are ways that you can put these into trust as well and make them immune from estate taxes, right? Completely. They're completely out of your estate. So you can set those up as well. So there's a lot of ways, but the reality is if you just follow the rules, you'll never pay a tax on any gain or use and benefit your family for these dollars.
Sure. Well, like I said, look at this. We've chewed up 30 minutes already. But again, I just wanted to remind everybody, head over to perennialpride.com, see what Tom and his team are doing there. There's a lot of great content that Tom is freely giving out. But Tom, before I let you go, is there a question or concept you wished we would have covered here today?
I think for me, one of the things I wish we'd covered maybe is how best to sort of use these dollars to fund the next generations and teach you how do we use this to teach them about money and sound principles.
Sure.
Because that's the type of thing that I think we can get so tied up, and me personally, because I love talking about it, into mechanics of life insurance and how it can be used and all the tax benefits. But what I find to be especially most compelling, especially relates to me, my children and others, is how this teaches them how to use money and what are sound money principles that can be taught. That they don't teach these things in school, and they don't teach how banks make money and all those sorts of basic concepts. Is a heart of a lot of what inspires me, because it hopefully will transfer to my family and all the clients I get to work with and their children, and have people owning, controlling their financial futures. That to me is bliss, if that could happen. Yeah.
So why don't we go down that road just for a few minutes? Like, why, this is putting you on the spot again. Why do you think this is such a big part of our lives, especially as we're growing older? Why do you think that this is such a gap in the education system?
I mean, I think there's a lot, there are two things that I think about this. I think there are people that are scared of the topic, right? They think it's complicated, and so they shy away from it and don't want to openly talk about it. I mean, I grew up, no one really talked about money. I didn't find out till I'm an adult that my family is having money problems. And so it just isn't an open topic. We give it such a more power than it really deserves, frankly. And I said, we need as a society to be able to talk about it. It isn't what defines people's lives and their successes. There's more to us as people than that. And I think we just sometimes give it so much power over us. And then we also hear so much from a marketing lens of what is the right way to do things. And we hear so much noise from Wall Street and how you should do all of it. It just makes it difficult to have these conversations about alternative ways to doing it, because there's so much noise around that. I just don't think, and people can think negatively about it, but I think there's a lot of powers that be that like that, right? For people to be ignorant around these things so they can stay within their control and the confines of a system that is very lucrative for those who are controlling it. But for the people who are in it, it actually reduces their control and allows them, makes them be part of the system. And so I think there is something to that. And so now that I've broken away from it, I can feel it and I know it. I see it. I see where you can have that control and ownership of it. But it does take a little bit of energy and and willingness to kind of learn new things.
Yeah, you're sounding, if anybody follows Robert Kiyosaki outside of his Rich Dad Poor Dad books, you're pretty much saying what he says, is that we're incentivized to stay where we're at. When I was going to school, one of the things, an exercise that we did and I'm going to date myself a little bit, but as far as I know, they don't do anymore, is that we used to, like, I was in a social studies or an economics class, and we even just played around with the stock market. It was all fictitious, of course, but at least they introduced us. I don't think that's even a thing anymore.
Yeah, I see it in little spots, but it is still centered around stocks, bonds, mutual funds. That's finance. And there's so much more to it, even in the world I live in with life insurance. I mean, to protect your biggest asset that you own from day one, don't even talk about it, right? And they used to save money. That's where people used to save money, was in life insurance, until mutual funds started getting into the fold, right? And then the dialogue and sort of positioning went away. And so I think it's just, a lot of things people hear and they take it for granted and as a truth, and they don't test it. They don't question it. It's easy. So unfortunately, some people will take that leap, like especially in your audience who are real estate investors. Most people don't get into it. Why is that? Right? They won't. It's too scary. It's too risky. So they just kind of stay in their little bubbles of what supposedly is safe. Mm-hmm. And if anyone looks at today's markets, I don't know if anyone would say they're safe.
Yeah. Well, I just think it's interesting. It's one of those things we've either. I feel like I see a lot of people, they either set it and forget it. We're trained to contribute to our 401ks, or you might have a Roth IRA or something like that, something traditional, or stuff that stuff you're talking about. Let's be honest. I mean, for the most part, it's fairly straightforward and kind of boring to the average person. It gets drowned out by these people screaming at them that real estate investing can be a get rich quick scheme, or something like that. So it gets drowned out by this. It's just loud.
Yeah, it is loud. It is loud. And that's why I use, from our lens of the safe house of money of life insurance, to get into things that people can control. That's where you invest, right? And that could be anything, whether you're business or real estate, or if you are an expert in stocks and bonds, fine. But be an expert and understand it and know where you're investing. If you don't, then in my mind, you're mostly gambling, and right. It's likely to be high risk with less reward. And I said, so I really encourage people, especially around real estate. I get it all the time. I want to invest in real estate. I ask them, the very first question is why? What is it that you're trying to do with this? Because it's just an investment tool, but what is it for? Why is it so compelling to you? Because then you'll get passion and sort of interest in learning it and getting it. Then you're going to probably mitigate risk and probably be more successful in your investing, right? Because you have a purpose and you have a passion for it, and you're going to probably want to learn more and more each day. So I always encourage people to think about those sorts of things as they're thinking about their financial life and investing, because you can make money in a lot of different ways, but understanding why you're doing it is, to me, of the utmost importance.
Well, on that note, I really appreciate your time, Tom. This was great. And again, perennialpride.com. You're welcome back anytime. I hope you'll take me up on that.
Oh, absolutely. Thank you. I appreciate your time. Love talking with you.